get underway. Well, hello, everyone. Cynthia Tomaine once again with Interactive Brokers, and thanks all for joining us for today's webinar, where we'll be discussing trading businesses and saving taxes for this year and next. I'm very pleased to have with us today Robert Green, who is CPA and CEO of GreenTraderTax information as well. So without any further ado, what I'm going to do is move this right over to Robert's slides, and we'll get started here today. Thanks for joining us, Robert. I'm going to pass you the controls. If you can go ahead and share your desktop, we'll get started here. Thanks for joining us, Robert.
Thank you, Cynthia. Welcome, everybody. And I'm just getting set up here. Okay, let's get started. Today's webinar is how trading businesses can save taxes in 2017 and 2018. A trading business is when you have trader tax status. You're in the business of trading. And that always opens a lot more tax benefits than for investors. So today is December 6, 2017. The House and the Senate are starting the conference to reconcile their Tax Cut and Jobs Act bills. So it's a fluid situation. It's changing quickly. I'm the presenter, Robert A. Green, CPA. There's a current photo. I was out in Beverly Hills seeing some friends. I am the managing member of G&M Trader Tax. That's Green, Neuschwander, and Manning, LLC, and the CEO of GreenTraderTax. We focus on traders. Trading is a real profession, and other tax professionals and solution providers underserve them. Traders deserve tax advice from CPAs and tax attorneys who are acutely aware of different tax laws and regulations that apply to them. I write for Forbes. There's a lot of tax content during tax reform. Tremendous number of articles. I've never seen that many. But the clients have been telling me, thanks, Bob, because you're focusing on our niche, traders. You're not going to get that in the other articles you read. And trading is nuanced. It's a little different. So clients want to know, how does this translate to me, to my trading business? And that's where we come in. We're a big fish in a small pond, and we're really proud of that pond. Of course, trading is a huge pond, but it's not like big corporate America or Silicon Valley or Wall Street. Now, I'm considered a leading authority on trader tax for many years now. You can see my annual trader tax guide. I'm writing the 2018 guide right now. It's going to be ready in early January. As I said, I write for Forbes magazine. I wrote the Business of Trading column for Active Trader for 14 years, and you'll see me in all the leading media, interviewed, and also at the Traders Expo and other speaking areas. This information is educational. It's not one-on-one tax advice. When I write the content, I'm talking to all of our clients at once and users. Not an individual client, because you need a customized solution, and everybody's case is a little bit different. Now, I prepared this presentation based on current law. You're preparing your 2017 tax returns this tax season. You're finishing out the year now, and it's based on current law. The Tax Cut Act applies for next year. With one exception, expensing can start after September 27th. That's for like big corporations. You already get all the expensing you need 100% up front. So remember, when we talk about the tax cut changes, it's for next year. But when we talk about 2017, it's current law. And remember, I said it's educational. I encourage you to go out and get expert advice. I think you should use us, of course, but use anyone you'd like who's a trader tax expert. Let's start. So I have two sections today. We have the 2017 year-end planning for businesses, and then we're going to talk about the tax planning for next year based on the Tax Reform Acts. So let's start here. Trading businesses should do year-end tax planning, including execution of officer payroll and related employee benefits, health and retirement in an S-Corp or C-Corp management company. we've been recommending to traders for years now to use the S-Corp to unlock the health insurance and retirement plan that a sole proprietor trader cannot do, and a partnership, spousal partnership, has great difficulty in doing. So the S-Corp, we create the earned income with the compensation, so you can deduct the health insurance and the retirement plan. You can only do that on earned income. You can't do that on underlying trading gains. The S-Corp creates that earned income for you. You start with 0 earned income, and then you pay the wages to create some earned income. That's the opposite of a normal business that starts off with underlying earned income. So now's the time to do that creation of the earned income. You've been counting on this all year long as a big deduction, and now is the time to make it happen. So with 3 weeks remaining in 2017, trading businesses should do the year-end planning now, including the vital execution of the officer payroll and related employee benefits, health and retirement, in the S-Corp or C-Corp management company. Now, the Tax Cuts and Jobs Act bills, I'll just call it the Act, it lowers tax rates on businesses in 2018. So it's wise to consider deferring income to 2018. You may not want to, if you're holding on to some investment positions that have embedded large capital gains, you may want to defer those. If you're a service business, you may want to, not complete all the projects, and you want to accelerate your business expenses. We're going to go through the details of that. Let's start with the officer compensation that must be executed through payroll. Traders eligible for trader tax status need an S-Corp trading company or C-Corp management company if they have a dual entity with a trading partnership and C-Corp management company. Now is the time to deduct the employee benefits for the owners, including health insurance and retirement plan contributions. Why do I say now? Because we don't want you funding a retirement plan if you had losses for the year. So we don't want the payroll throughout the year. We want to wait to see where you stand now and commit to a December payroll to take care of all your business. It's too late, by the way, to form a new S-Corp for 2017. So don't call me up later today and say, hey, Bob, I love the session. I want to set up an S-Corp. Let's do it today. And then I had a lot of gains year to date. I want to put those into the S-Corp and then do the retirement plan. It's too late. You need a few months activity to qualify for trader tax status. Trading for just December is not enough to impress the IRS. Plus, the entity tax return may only report trades made within an entity account, not your gains earlier this year. Now is the time to think about the entity for next year. So don't always miss the boat on taxes. It's important to know what you're doing and to act on time. Now, S-Corps need to execute the 2017 officer compensation with these deductions included before year end, so don't miss the boat. We have a payroll service provider that works with our clients, Paychecks. They know exactly what we're dealing and how our strategies. And if you contact us, we can put you in touch with that team. I'm going to go over some of the details. So the S-Corp officer health insurance premiums, that's an important deduction. That might be $20,000 a year for your family. With an S-Corp, it's a little tricky. So again, you're sitting with one of our CPAs in the firm and you're working with Paychecks and you're deciding, how much is my W-2 going to be? What is going to be my officer compensation for December? Is it just going to have the health insurance component because maybe I had losses for the year? If I had profits, is it going to have the solo 401k elective deferral, the $18,000? That's where the most tax juice is from. So my W-2 is going to be 18 plus the health insurance? Or am I going for the gusto to maximize the solo 401k with wages of $144,000? You have to commit to that before year end because it's got to be on the W-2. So W-2 wages should include health insurance premiums for 2% or more owners of an S-Corp, which means the trader, owner, and spouse if both provide services. When you own more than 2% of an S-Corp or a partnership, you're not really considered an employee, you're considered a partner, and the rules are a little different. You can't just say, I own 99%, my spouse owns 1%. The attribution rules apply. So if your spouse works in the business, they may also have a payroll and employee benefit plan deductions. They could be an owner, but non-active. If they're active, pay them something reasonable and maybe think about that elective deferral on the solo 401k. The health insurance premium component is not subject to payroll taxes. So if you had losses this year in your S-Corp and your health insurance is $20,000, you put that $20,000 on the W-2, payroll, gross wages, it's a reimbursement. You're getting reimbursed for the individual policy that you got during the year. It does not apply to ex-employer coverage, so COBRA doesn't count. It's got to be non-employer provided insurance during the entity period. So you plop that $20,000 on the wages. There's no offsetting payroll tax. There's no Social Security, no Medicare. It's just a flat-out deduction. It's better than what a sole proprietor trader would have because they have to pay SE tax before they have that AGI deduction. This is a great loophole for an S-Corp. So at a minimum, that's what your W-2 is going to be, that $20,000 health insurance component. Now then, you as the owner are going to have W-2 wages with it, $20,000, and then you take the AGI deduction on your individual return. So the S-Corp gets the deduction through compensation. So your Schedule E is $20,000 of a bigger loss. But then there's a wash with your wages and the AGI deduction. Don't get confused. You'll look back at this later. Now, if you're a trading partnership with a management company, it might be a little bit different. Now, some traders use a dual entity structure, a trading partnership to be free of all entity level taxes on a state level, like let's say in California or New York City or Illinois. And they have a separate management company as a C-Corp or an S-Corp. So, you know, the management company is the one doing the employee benefit plan deductions. So it's going to execute the year-end payroll and the health insurance deductions. It's a little different with the C-Corp management company. It may deduct the health insurance premiums and a health reimbursement account directly on the corporate return. It doesn't have to do that tricky thing with the wages that the S-Corp has to do. By the way, health reimbursement account, HRA, is a wonderful thing. I wrote a blog about the health savings plans. You can deduct all your out-of-pocket, all your deductibles, all your co-insurance, your co-pays, not just the health insurance. As we move towards high deductible plans, if they repeal the mandate and that comes back, you definitely want to get that out-of-pocket stuff deducted. You can do that with the C-Corp management company. I don't recommend the dual entity solution unless you really need it because you're in California, Illinois, New York City, where there may be some small entity level taxation on the S-Corp. I like to keep it simple. But if you have tremendous out-of-pocket, you need a health reimbursement account, we can talk about it. You can do that on a Schedule C too, by the way, with a spouse. A trading partnership, if you have this dual entity solution, you have some more business to take care of before year end because it's more complicated with the dual entity. You have a trading, and I don't want you to get lost in the weeds. We're going to move past this in a second, so stay with me. The trading partnership has to pay the admin fees to the management company before year end. You got to keep up the structure, otherwise the IRS won't respect it. Now, if you're not a trading company, compensation is a little bit different. The IRS requires S-Corps with underlying earned income, like let's say you're an investment manager, you have a S-Corp for your management company, for your hedge fund. That's a dual entity solution in a sense. You have underlying earned income, so the IRS wants reasonable compensation. Current industry practice is 25 to 50% of net income. That's a loophole for S-Corps that the House was trying to address a little bit in their bill, but it failed, and their final bill did not change it. Senate's trying to address it a little bit too with a wage limitation on the benefit. They're trying to get S-Corps to pay more salary to fund more Social Security and Medicare. But it's pretty tough to do because a lot of people use this loophole. The IRS does not require a trading S-Corp to have reasonable compensation because it has underlying unearned income. However, the IRS does look for officer compensation on S-Corp tax returns and at a minimum include the health insurance component and wages. If you come to me for a consultation and we're going to talk about an entity and you don't need employee benefit plan deductions because you have them in another job or another business, I'm not going to recommend the S-Corp because it is extra work. There is payroll. The IRS is looking for some payroll. In that case, I'm going to recommend the partnership where we could have special allocations too. Now, with partnerships, there are guaranteed payments to partners. Partners don't get payroll. They get guaranteed payments. An LLC with earned income, not a trading business, filing a partnership return or general partnership should use guaranteed payments for officer compensation. You don't have to lock those in necessarily before year end, although you should have those pretty much provided for in your agreements and modifications. A partnership tax return with underlying earned income may arrange health insurance and retirement plan deductions in a similar manner to S-Corps. So you would increase the guaranteed payment, and then you would have the income and AGI deduction on the individual return. The IRS does not permit an investment company not eligible for trader tax status to have guaranteed payments and employee benefit deductions. So if you're an investment company, you don't have trader tax status, remember, you don't have trader tax status in your entity, you can't do compensation, you can't do employee benefit plan deductions, period. Unless you're talking about maybe a C-Corp, and a C-Corp that's an investment company can't deduct anything. And there's a great misunderstandings about that. So you need trader tax status wherever you go, and we've had prior webinars about that. Now, a spousal-owned trading partnership that doesn't have underlying earned income, it has trader tax status. You can try to pay a guaranteed payment. You can try to pay an admin fee. You're not going to get anywhere. It's going to face significant difficulty achieving self-employment income for a retirement plan deduction, because as soon as you pay the fee or the guaranteed payment to fill up the glass, the partnership passes through that fee deduction to drain the glass. The S-Corp doesn't pass through the fee deduction. S-Corps don't pass through SEI. Partnerships do. That's why it's different. I don't want to tie you up in that difference now. Let's get back to the business at hand. So far we said, okay, you're talking to us about your payroll. You're working with paychecks. You're deciding how much to put on the W-2 for the health insurance. We just covered that. Now how much do you put on for the retirement plan? You want to establish a solo 401k retirement plan before year end. A SEP IRA you can do next year, but the solo 401k is so much better because it's got the elected deferral and the profit sharing plan that the SEP IRA has. SEP IRA doesn't have the elected deferral. That's where the tax juice is. You can max out the 25% profit sharing plan with $144,000 of wages. With a SEP IRA, you need way over $200,000. That would force you to pay a lot more Medicare tax at 2.9%. You got to open this solo 401k, folks, before year end. If the S-Corp trading company or C-Corp management company is profitable, consider a solo 401k retirement plan contribution. It must be established by year end. Execute the 100% deductible elective deferral portion through officer payroll before year end. The 2017 maximum contribution is $18,000 or $24,000 with the catch-up provision for age 50 or older. Most of you are familiar with that. You have a 401k in your job. You're used to seeing the W-2. It had gross wages of, $218,000 and $18,000 deduction for the 401k, and then the taxable wages of $200,000 because you maxed out. Now, some people integrate, have a trading company on the side of work. They do only $8,000 of the 18 in their job, and they do the other $10,000 through their trading S-Corp because you can't double up on the 401k elective deferral. And they do the profit sharing plan in their trading S-Corp. So if the company has sufficient income, so you start working with us now, next week, you made $200. You want to consider the 25% deductible profit sharing plan included in a solo 401k. The maximum profit sharing plan PSP contribution is $36,000. $36,000 divided by 25% is $144,000. That's all the officer compensation that you need. So you run through $144,000 of officer compensation. You have the $18,000 deduction on the W-2, and then the other $36,000 you can pay up until September 15th of next year. You don't have to pay that before year end. And it's going to be a deduction on your 1120S S-Corp tax return. The elective deferral, $18,000, you're going to need to pay that by the end of January because that's on your December payroll. If you make a lot of money, consider a defined benefit plan with higher contribution limits. The solo 401k is a defined contribution plan with those percentages. This is a defined benefit plan. Businesses that achieve consistently high income can arrange a $100,000 plus contribution deduction with a defined benefit plan if the owners are close to age 50. Business owners should work with an actuary on complex DBP calculations. A DBP must be established before year end, but you can do most of the funding in the new year. Setting up a DBP can take several weeks, so get started by early December. Basically, the actuary is going to say you need $2.5 million to retire or more. You're way underfunded. Interest rates are low. You have to, fund it with a lot of money every year to catch up to get there. And you can even turn off the payroll after the first year or two. It's an incredible benefit. I'm surprised that more clients don't go for this. It takes a little more work, which doesn't cost much. And it's fantastic. But you're making a commitment to these, defined benefit plan contributions. I didn't see any watering down of that in the tax bills, but until the final stuff comes out, we'll see. Now, let's move on from the compensation issues. That's the tricky stuff with the payroll provider before year end, but it's crucial. Let's talk about wash sales. You want to convert 2017 wash sale losses into a 2018 ordinary loss. If you have wash sale loss deferrals at year end on trading positions in your account, and you've been a sole proprietor business trader. We're talking about businesses today. That means sole proprietor businesses too. The compensation issues we just talked about are not for the sole proprietor trader, but now we're broadening the conversation to include the sole proprietor trader too. If you claim trader tax status for 017 and 018 as a sole proprietor or an entity, and you have some wash sales at year end that you have to defer, you can't take those losses this year because you take a loss in December and you buy it back within 30 days, a substantially identical position across all your accounts for the taxpayer ID. If you make a Section 475 election for 2018 by March 15th for a partnership or S-Corp or April 17th for an individual, that's going to convert the wash sale loss deferral on the trading positions at year-end 017 into an ordinary loss on January 1st. That's a lot better than a capital loss carryover. So people are always saying avoid wash sales like the plague, but if you have a capital loss carryover going into this year-end, You don't want more capital loss carryovers. You'd rather have a wash sale loss that you can convert to an ordinary loss next year. Again, there's a nuance. Just covering it lightly today. If you think this may apply to you, get back to me. Now, businesses have a choice of accounting method when they get started. Most small businesses without inventory choose the cash method, which reports revenues when collected and expenses when paid. So you might have set up a new sole proprietorship trading business or a S-Corp or partnership in 2017, and you can choose your accounting method. For the expenses, for the trades, there's other accounting methods like realization, or which is a default, or 1256, or the 475 election. I'm talking about the expenses now for trading. A cash method, traders can defer gross revenues. You don't have revenues as a trader. Cash method, taxpayers, I meant, other businesses. And all businesses, trading and otherwise, can accelerate expenses more easily than if they use the accrual method. If you own a small business, consider postponing completion of client engagements. If, let's say, you're an attorney, and invoice them in 2018. In cash method, taxpayers can hold off on collection efforts until 2018. Now, be aware of constructed receipt of income rules. For example, you're a prop trader. You get a 1099 miscellaneous. Your prop trading firm offered to pay you out your share of profits as a fee each month, and you declined. You turned your back. You said, leave that in my trading account to reinvest it. You had constructive receipt of income, and you have to pick that up. So consult your accountant about that issue. Now let's talk about expensing. Expensing is great for traders now, and tax reform makes it even better for bigger businesses, just letting you, first of all, just deduct everything up front, 100% for a huge amount. And what you can't do up front with a huge amount, they just really lower, lessen, reduce the holding periods, like for real property, whether it's commercial or residential. And they also beef up, like luxury autos, first year depreciation. So they just make expensing so much better. But it's already incredible for small businesses like our trader clients. You have all the expensing you need under current law. Businesses can expense new tangible property up to $2,500 per item, a great way to defer income. Rates are high this year. They're going to be lower next year. They've changed how the brackets work. Why not take a deduction this year if you're planning to get a new computer? Purchase and begin using the tangible property before year end. So order it, get it shipped fast, put it into service, and expense it. Arrange a separate invoice for each item not exceeding $2,500, and then be sure to make this de minimis safe harbor election on your tax return filing. No problem. The computer, you can't break it down into a separate invoice. It's flat out $4,000. So you take Section 179, 100% depreciation. For equipment, furniture, and fixtures above the tangible property threshold, $2,500, use Section 179 depreciation, allowing 100% depreciation expense in the first year. The 2017 limit is $510,000, very generous, includes off-the-shelf computer software. The IRS limits the use of 179 depreciation by requiring income to offset the deduction. You have trading losses. You might not be able to get the 179 depreciation. That's why the tangible property expense is important. But it can also look to your wages or your spouse's wages. That's nice. S-Corps need an accountable reimbursement plan for reimbursing home office. Partnerships are more flexible. They have unreimbursed partnership expenses, UPE. You need to use or lose an S-Corp accountable plan before year end for reimbursing business expenses paid individually, including home office deductions. It's another formality of the S-Corp, like the payroll. You got to do this, folks, before year end. If you have an accountable plan in your job outside of trading, use or lose it before year end. Now, if you have a partnership, your LLC operating agreements and general partnership agreements may provide that partners should deduct home office expenses as unreimbursed partnership expenses, UPE. That you just deduct that right on your tax return even after year end. You don't need the formality of doing any of this before year end. It is better if your partnership agreement speaks to this. Now you want to capitalize expenses for a new business. Let's say you don't have trader tax status yet. You're planning to have it in January. If you plan to become eligible for trader tax status or another type of business in early 2018, and you're not in business yet, consider capitalizing late year 2017 purchases for business expense deductions in 2018. That may be a lot better than just not getting any deductibility or very little deductibility this year. Like investment expenses this year. I suggest this strategy for Section 195 startup costs, including training and mentors, Section 248 organization costs for setting up your new entity in December, getting it ready for January, and setting up your internal use software for an automated trading system. You want to capitalize it and then expense it when it's placed in service. Otherwise, you may lose out on these deductions. A lot of clients work with us for 2017, even though they're not getting all their trader tax status together for next year. They have a lot of trading activity this year. They want us to help sort it out. They want us to assess trader tax status and then what to do with all their expenditures this year to get the best benefit either this year or next year. Okay, that was taking care of your 2017 business. Some of it was in the weeds. I hope I didn't lose you on that, but you got to take care of the business and get in the weeds. Otherwise, you're going to miss the boat. And this is sort of like an alarm bell that you got to follow up with us. Now, my partner, Adam Manning, has been following up with our clients. He has sent them, big files of worksheets, of information, of exactly what needs to be done. So just, sign up for the tax compliance service, work with Adam and our other CPAs to take care of this year-end business. And there's other great year-end planning as well, like, for example, prepaying your state taxes, because that is going to be repealed as an income tax deduction next year in both House and Senate bills. Hopefully they allow some, but they may not. So you may want to prepay it this year, unless, of course, AMT wipes it out. So there's a lot of year-end planning to do. We covered it in the last webinar on individuals. Today's is just on business. So now in the second half of this hour, 27 minutes left, and we'll go a little over with questions and answers. Let's talk about how the Tax Cuts and Jobs Act impacts trader entities. The Senate's pass-through tax deduction is suitable for most traders. The House is not. And the C-Corp may be ideal, or maybe not, for a high-income trader living in a tax-free state. If you live in a high corporate tax state, like California, New York, Illinois, many states, 44 states have corporate taxes, the C-Corp is probably not for you. If you make, $1 million a year and live in Texas, it could be for you, but there's a lot of unknowns, and I don't think you want to be the guinea pig. And anyway, the Senate 20% flat tax doesn't start until 2019, so you're not even thinking about the Corp for January. You're still thinking as a pass-through entity based on our prior content, which is the cake. And now I'm going to explain to you how to get some icing on the cake with the tax cut changes. So congressional Republicans are advancing the Tax Cuts and Jobs Act at a fast pace and expect to pass the legislation by year end. Why are they rushing? Well, if you don't rush and take care of business, sometimes stuff doesn't get done, but that's a mistake to rush. Another reason they're rushing is that we're starting another tax year. The IRS is getting ready for another tax year. It's very inconvenient for business and individuals to have retroactive changes mid-year. We don't want changes in the middle of the year. We want them for an entire year. So they got to get their act together now. Traders are considering, and I think they will, traders are considering changes to their entity structure for 2018. And you'd like to do that by January 1st. Sure. Listen, don't rush. You do not have to rush. If you want to wait for the final bill, wait for our final, the dust to settle, to see all the collateral damage, see what the final advice is. You can trade as an individual with your existing entity for the first month or two, and if you want to change, you could change later. But if everything is ready to go, and you're ready to go, and you want a clean year for next year, then you can also pull the trigger and form your entity in mid-December and have it ready for January 1 and make the elections on how it's going to be taxed. We're going to cover that later. Now, big picture. Should you continue trading in an S-Corp or LLC partnership and perhaps qualify for pass-through tax cuts, the icing on the cake? Or should you switch to the C-Corp for the new low 20% flat tax rate? Maybe the House will convince the Senate to start the C-Corp in 2018, the lower rates. Maybe they'll bump it up to 21% to help pay for it. President Trump said he would be open to that. So the tax cuts for pass-through entities, that's a big section in the House bill and in the Senate bill, and that's where most of you have interest. The Senate and House bills are different on pass-through tax cuts, and the Senate provision is better for TTS traders. I read this morning that experts expect the Senate provisions to prevail. One, because the Senate is probably going to be the vehicle, the bill for passage. They have the Byrd rules, they have the deficit constraints, they have the much narrow, 52-48. It could go down to 51-49 with the Alabama election. And also, if they had more time to just think it out. And I don't like the House bill. The House bill says 25% for pass-throughs. I said from day one, I was the first one saying it. That's bogus. That's a mirage. The only one who gets 25% is someone who owns a passive, who's a passive activity owner. Why should your Uncle Frank, who does nothing in the business, get 25% and you who run the business get nothing? Because maybe it's a service business where the capital percentage is 0% and you don't have a 10% alternative capital percentage. You don't have a lot of equipment. It's ridiculous that the passive owner gets 25%. Everyone else either gets, 30%. If you're a manufacturer, 30% is a capital percentage, and 30 times 25 is all you get. So at the best, your tax rate is 32%, not 25. So that's at the 35, at the 30, no, excuse me, at the 30, if you're in a 35% bracket, you're only getting a 3% saving. So the House bill is a mirage for traders. It's no good. The Senate bill can be really good for traders because they are much more labor friendly. They don't penalize the company for having labor. The House was so focused on investing in robots, it seemed like to me. That was anti-labor. They penalized labor. So hopefully they're going to go with the Senate bill, and I'm going to go through some of the details on it, and then I'll fill in the blanks. So the Senate pass-through tax deduction. The Senate bill provision for pass-through entities has many limitations, especially for service businesses, but still it's much better than the House. A trading business eligible for trader tax status is a service business. Now, one tax writer said to me, Bob, I don't think it is a service business the way I read the definition. But the definition says, accountant, lawyer, architect, doctor, it goes through the whole list of service providers, comma, investing and investment management, comma, trading and dealer 475. I mean, maybe I'm not as smart as that other expert who used to work for the Joint Tax Committee, but to me it says trader. So until I see something different, I think a trader is a service business. So that gives it a limitation. Now, it's based on qualified business income. That other professional and us, we think it's 475 ordinary income is included in business income. The definition excludes investment-related capital gains. Notice it says investment-related capital gains. I think we can squeeze in the futures trader that has capital gains that are business-related, or other financial product traders that have tax treatment that's not ordinary, that's capital gains. For example, they trade securities, but they don't want a 475 election. So I haven't closed the door on that yet. And if you see my blog posts, they're always evolving based on the latest information and interpretations. So read the last one from this past weekend. Both the House and Senate bills have that same definition, comma, traders, and they have the same definition of qualified business income. So here's the limitation for the pass-through deduction. In the Senate bill, a pass-through service business owner is eligible for the 23% deduction on qualified business income. So you make $1 million, or you make $500,000 trading with securities with 475. You have trader tax status. So 1, you're a service business. 2, you have qualified business income. 23% of that QBI might be your deduction of the QBI, qualified business income, but then there's a lot of haircuts. The Senate said we can't not include professional service firms, because after all, I know that President Trump wants America to be a manufacturing country, and good luck to that. I'm rooting for that too. Jobs, everything. But we have been a great service power worldwide, and to leave out service providers with all the jobs they create is not fair. And I'm so happy that Senator Johnson and Daines screamed to get better benefits. They beefed it up from 17.4% to 23%. They beefed it up the limit from like 100,000 or a little bit more to 500,000 married, 250,000 other taxpayers, including single. So, and then there's a deduction phase out up to 600 married and 300 other taxpayers. So I have a look at my blog post, how to set up the business trading entity for tax cuts. I wrote that on Saturday after the tax cuts finished Friday, updating a blog actually from a few days before. And I show you the exact examples of who gets it, who doesn't. So you're single, your taxable income is, your QBI, your taxable income is under 250. So you're allowed to have this 23% deduction on your QBI, and it's on the lower of your QBI or your taxable income. I walk you through the exact example. I show you how all the haircuts apply on the Senate's 5 haircuts. They make you jump through hoops, but bottom line is this. You're doing the S-Corp to have your cake, the health insurance and retirement plan deduction. If you have a great year and you, even after the health insurance deduction, you're above these taxable income limits, you're not going to get the 23% pass-through deduction, go for the profit sharing plan deduction. You made a lot of money, you can do it. That's the icing on the cake for you. But if you didn't have a great year and you're under the taxable income limits, hey, you'll get that Senate 23% deduction. You're well positioned to have your cake and icing too. Now the House pass-through tax rate is a mirage. It allows service businesses a puny benefit to use the 11% pass-through rate rather than the regular 12% rate, or 1% difference, so what, on the first $75,000 of business income for taxable income under 150 married or 75,000 other taxpayers, and the phase out is up to 112. So if your taxable income as a single trader is under 112,500, so what? You can use 11% rather than 12% in that bracket. You make a lot, you make anything more than that, they don't respect you as a service business. A service business can qualify for the maximum 25% pass-through rate if it has alternative capital percentage of 10% from a significant investment in business income. And it might include internal use software. So if you're a quant trader and you have a lot of servers and a lot of business equipment, you might have alternative capital percentage of 10% or more. And so you might get a minor, very, very minor benefit compared to the Senate. But if you're most traders, where you can't, by the way, count your trading capital as alternative capital. You know, if you have a couple of computers and monitors, that's not going to cut the mustard. So you know what the House gives you? Zero benefit, except for that 1% benefit as a service company that I told you above. I hope by this time next week the House pass-through rate is history. I've been against it from day one. Now, why am I talking about C-Corps? Well, everybody talks about the 20% rate. A C-Corp was not a suitable choice for a trading company in the past. But with the new 20% tax rate that's attracting, you know, everybody like a flower, it could be for some high-income traders in states without a corporate tax, with a lot of conditions that and dangerous conditions that I'm going to talk about. If the trader doesn't qualify for a pass-through tax cut, so if you know you make, you're single, you make way over $250 every year, you're confident of that. You say, Bob, I'm not going to get these Senate tax cuts, pass-through cuts, and I'm moving to Texas. I'm not paying California 8.84% corporate tax rates. Maybe the C-Corp will be for me, and maybe the Senate maybe they'll make it effective for next year. We'll see. So a C-Corp sounds attractive. It's not as attractive as it sounds. I'm going to go through that. In the Senate bill, C-Corps benefit from a 20% flat tax rate. By the way, people who use C-Corps always took advantage of the first $50,000 with the 15% rate. This is a tax hike on the first $50,000 of a C-Corp because this is a flat rate. And then there was the next 25,000 that had a like 22% rate, and then it shot up to 34. Now it's just flat 20%. So when you compare that to the individual rates that go up to 38.5% for an individual, so you're making $1 million trading. You're going to be paying taxes in the marginal bracket of 38.5%. Plus you got 3.8% Obamacare net investment tax. So you're saying to yourself, well, wait a second, I gotta talk to Green because the maximum difference could be a whopping 22.3% in federal tax rates. How can I not go for that? Well, I'll tell you how you cannot go for it. The Senate bill, first of all, delays the corporate rate to 19, whereas the House bill commences at 18. The Senate will probably prevail with conferencing. Let's see. The 20% corporate rate is not as good as it seems at first look. The average marginal individual rate is closer to 30% for high-income taxpayers. And with the inclusion of the 3.8% NIT, the actual difference is 14. It's not 22.3. It's actually 14 because when you cross from the 35% bracket into the 38.5% bracket, right at that crossover point, if you look at the total tax and divide it by the crossover income, the average rate is 30%. Now, what people forget about C-Corps is double taxation. The entity pays its corporate tax, then it pays a dividend to the owner, and then the owner pays a qualified dividend tax of 15% or 20%. It's the capital gains rates, plus the 3.8% net investment tax. So 15 plus 3.8 or 20 plus 3.8, that's greater than that 14% actual difference. It wiped it away. Now, double taxation on the state level absolutely can lead to the C-Corp paying higher taxes than the pass-through entity. Now, it all comes down to, can you hold off on paying qualified dividends? Because the C-Corp, again, the C-Corp pays taxes first on the entity level, the owners pay a second-time individual. When C-Corps make a cash or property distribution to owners, it's a taxable dividend if there are earnings and profits in the C-Corp. If the individual holds the stock for 60 days, it's a qualified dividend subject to the lower rates, not ordinary income. A high-income trader will likely pay the 15 or 20% rates. Now, all the trader does is trade in the C-Corp, has no income on the individual return. You definitely want to pay some qualified dividends to use the standard deduction and to take advantage of the 0% capital gains rate for that first low tax bracket. So check that out on our website. But it's still not for the low-income trader in a high-income corporate state. And you'll see the example how it did not work. Because remember, the lower income trader gets the whopping 23% pass-through deduction. And that is so much better than the C-Corp, even without any qualified dividends. You'll see that example on my website. The big thing about the C-Corp is the accumulated earnings tax. If the C-Corp does not pay dividends from E&P, the IRS can assess a 20% accumulated earnings tax. If the C-Corp exceeds a threshold and cannot justify a business need for retaining E&P, the IRS threshold is $250 or $150 for a personal service business. An accounting firm, they don't have any equipment, they're not really expanding, they just have people working for it, or maybe it's a small solo practitioner, doesn't really need more than $150,000 of accumulated earnings, but doesn't want to pay dividends, doesn't want to pay the dividends tax. The IRS will hit them with the 20% accumulated earnings tax. Where does a trading company fit in? Will the IRS consider it a personal service corp, like they did with the definition for pass-throughs, where they treated a trader like a service business? Maybe. Can the TTS Trading Corp demonstrate to the IRS that it needs E&P over the threshold because it says, hey, I need to reinvest this trading capital as working capital. I should be able to build this up and not pay out dividends. I think they should be able to do that, but I don't know for sure because no one's been using a C-Corp for a trading company over the years. People haven't, it's been ludicrous to do that. So do you want to be the first one to test that? Probably not. So I don't think you want to jump into the C-Corp necessarily until that accumulated earnings issue is worked out. If you're an investment company, in the IRS views, they don't let you have any E&P at all. They'll hit you with a 20%. Now, historically, corporations avoided double taxation by paying out compensation, but then you're creating taxation at individual rates versus the new 20% rate. So you don't want to necessarily do that. Traders like a little bit of compensation for the retirement plan, but not too much. So you don't want to do what corps did in the past, just jacking up compensation. That defeats the whole idea of the 20% rate. State double taxation will ruin the C-Corp. 44 states have it. So go to the blog post. I'll explain more about that. I'll show you examples of that. But you remember I told you the qualifying dividends and the accumulated earnings tax already makes the C-Corp potentially a problem. The corporate tax rates in some states completely make it a bad idea. That's even if you're a high-income trader not getting the pass-through deductions. So California, bad idea. Texas, it could be a good idea. The 0.75% franchise tax applies to all types, and the no tax-through threshold is $1.11 million. Check those examples on the site. Don't try to avoid filing a C-Corp tax return in your resident state. Don't just say, hey, Bob, I'm going to set it up in Delaware or Nevada. I don't have to worry about California. I'll say, yeah, you're entitled to form your entity in a tax-free state like Delaware, but your home state requires registration of a foreign entity if you operate it in your resident state. Setting up a mail forwarding service in a tax-free state does not achieve nexus in that state. It doesn't work. Conducting your trading business from your home resident state, that constitutes nexus. You're not going to get away with the tax-free state setup. Now, you can move to Texas, lock, stock, and barrel. That works. Don't just move to Florida because they have no individual income tax. They have a corporate tax. I think it was 5.5%. And there's also some cons from the C-Corp. There's no lower 60/40 capital gains rates on 1256 contracts. A lot of traders have losses the first few years. You can't pass those through to your individual return with a C-Corp. If you don't have trader tax status, you can't deduct anything. And if you build up losses in your C-Corp with trader tax status and then you want to liquidate it to get the loss on your individual return, if you're lucky, you get a 1244 stock loss, and that's a limit on the ordinary loss up to 50 single, 100 married. The rest is a capital loss. So I don't like the C-Corp yet. We'll take a look at it. We'll see when it kicks in. You're still focused on an S-Corp. It's an excellent choice for most TTS traders. You'll get your employee benefit plan deductions. That's the cake. And you'll maybe get the pass-through tax cuts if you don't make a lot of money, the icing on the cake. And if you do make a lot of money, you'll do the profit-sharing plan to get icing on the cake. So for 2017, the TTS traders can arrange to deduct health insurance and retirement plan contributions in the S-Corp. The maximum is $54,000 or $60,000 if you're age 50 or older. The IRS raised it $1,000 for next year. The health insurance deductions could be $20,000 for your family. You're talking about $80,000 of deductions, plus a 23% deduction on your qualified business income. That might take you into a $125,000, $150,000 deduction. That's sweet. Sole proprietor traders and spousal partnership traders cannot achieve the employee benefit plan deductions. So you want to consider the S-Corp to get the cake for the employee benefit plan deductions and the pass-through tax cuts. Now, the tax cut bills bring the icing on the cake for the securities trader with 475, and I probably will make a case for the business trader with capital gains treatment too. I'm not giving up on that yet. You want to play it safe, you'll elect 475. But if you're a futures trader, you want to keep the 60/40 treatment. That's left in the bill. They didn't monkey with that. So you want to put yourself in a position to qualify for the Senate pass-through deduction. It will work with a partnership too. Now, technically, it should work with the Schedule C, but we are concerned, my partner Darren Neuschwander and I, that it may be difficult to claim this deduction for a sole proprietor trader since the Section 475 trading gains are on Form 4797 Part 2, not Schedule C. We have some traders in California that make so much money they don't want to bother with the S-Corp with the 1.5% franchise tax. They don't want the dual entity scheme. They're not going to get pass-through deductions. They're not going to do the C-Corp. They're just going to stay a sole proprietor Schedule C and maybe get some 60/40 benefits, but just make a lot of money. So again, you need a customized solution for you. Most traders are not making $1 million or $2 million. Most traders should consider the S-Corp for 2018, and they're not necessarily in California, which happens to be our biggest market. Texas is number 2, New York, Illinois, goes down the line according to population. A new trading business wanting to deduct health insurance and a retirement plan should consider the S-Corp for 18. That was our advice for 2017 and prior years, and it remains our advice for 18. Whether tax cuts are enacted or not, I think they will be enacted. If there are business losses from a business expenses and 475 ordinary losses, that tax loss insurance, the power of 475, with the pass-through, you're going to offset your other income and possibly generate an NOL. Both the Senate and House don't allow NOL carrybacks. That's unfortunate. That was a great benefit for our traders. We did the NOL carryback. We got the immediate refund. We replenished their trading accounts. Now you're stuck with the NOL carry forward, and it's limited to 90% of the carry forward income. So you don't just use it 100%, it's 90%. There's also the Senate has excess business losses. If you make a loss of 250 or single, 500 married, they make you carry it over to the next year. So there's a lot of stuff in the bills to disenfranchise you from immediate use of losses, from carrying back losses. They don't want to start paying out a lot of refunds right away. But the excess business loss is very generous, 250, 500. It's all on my blog, folks. So you're only going to consider the C-Corp if you're very high income in a tax-free state, if I work out the accumulated earnings tax. Let's see when that's effective, the effective date. There'll be opportunities for tax advisors to conceive other ideas based on final legislation and the anti-abuse provisions. For example, a trading company is a specified service activity. I went through that with you, with the limits on the pass-through tax cuts. But a second entity set up to receive royalties on licensing trading systems, if you can package up the secret sauce into an IP company, that might be available to get the pass-through deduction. Not for a huge amount, but something. A dual entity solution with a partnership in C-Corp, there'll be all sorts of ideas. Now, some of you have been waiting to get started with an entity. We've been waiting to see what I say now, next week. You can start a single member LLC and select the entity type afterward. We're going a few minutes over and then we'll do Q&A. I'm almost done with the presentation. Traders planning to be eligible for trader tax status in 2018 can form a single member LLC in December and remain a disregarded entity for 2017. So there is no 2017 LLC tax return. On January 1st, 2018, you admit a spouse for a partnership return and/or file an S-Corp election by March 15, 2018, retroactive to January 1st, or even choose the C-Corp, which I highly doubt that you would do. The C-Corp. That plan provides time to make the best assessment of your tax situation and planning, and it facilitates account openings in time for trading on January 1st or 2nd, wherever your products start trading. So you can get the certificate of formation, your EIN, go to Interactive Brokers, open up the account, fund it with money, have it ready to go on January 1st for trading. And there's no tax filing that you need to do for 2017. So stay tuned to my blog posts covering the Tax Cut and Jobs Act. Thank you for attending this webinar. We're getting to questions momentarily. Watch the recording afterwards. Come over to GreenTraderTax for additional information. Give us a call, 888-558-5257. Send us an email, info@greentradertax.com. Chat with us. Come back to the website, and let's take a look at the questions. Okay, and just 1 second now while I open the questions. And we'll spend about 10 minutes on questions. And let me just drink some water. Lucille J. How do I declare my options business as a business with the IRS? It's harder to qualify with options. We want 4 trades a day, 4 days a week. The holding period average must be under 31 days. So trade your weeklies and monthlies. And if you have some longer term horizons, make sure your average is under 31 days. And your rollover trades may extend your horizon, but they are actually a realized trade. So read my guide on that. Look at the prior webinars. I did have eligibility for trader tax status. GP asked, what kind of entity do you recommend for futures options? I'm going to recommend the S-Corp. And I'm going to try to get you those pass-through tax cuts too, because it's business-related capital gains. So I'm going to try to make it qualified business income. GP had another question, and I just answered that. Sheila P. I trade SPX options. If you're trading broad-based indexes or options on broad-based indexes, the E-minis, the options on the E-minis, those are 1256 contracts with the lower 60-40 rates where 60% is a long-term capital gain. That's wonderful. Craig N. If we do an annual payment for officer salary, can we take draws throughout the year? Well, you can take distributions of profits throughout the year. If there's not enough money left in the S-Corp to fund the $144,000 payroll that you want to do, quickly contribute some more capital to pay it back out as salary. So yeah, it's not technically a draw, it's technically a distribution of profits. Craig, with if only do annual December payroll, 401k elective deferral, yeah, you're going to do the elective deferral in your salary at year end. You can contribute to the profit sharing plan earlier, but I wouldn't do it. We don't want you to do anything with the 401k until December, because you could have great profits all year long and lose the whole thing in November. Hopefully not. We want you to have the patience to wait until now. Now is when to do it. That's why it's an alarm bell. Normally, why would I have an alarm bell now? We would have taken care of business earlier in the year, but we couldn't. Now we had to wait until now. So that's why the alarm bell, because otherwise you miss the boat. So it's last call, first call. MR. I'm not sure you'll get away with 20K W2 salary on your S-Corp once the IRS comes knocking. Here's the thing, MR, who may be a CPA, we don't have reasonable compensation rules for a trader. If the IRS says, why do you have a $20,000 health insurance on your S-Corp that made $500,000, we answer the underlying income is unearned income. We don't need reasonable compensation, and that's the end of the story. We never had an issue with that. Good question, and I did have that in the slides. So I'm going to try to get the questions where people don't ask multiple questions. I see many of you have multiple questions. I encourage you to have a consultation with me. That's $160 for 30 minutes. It works well. I opened up my calendar to more appointments going into year end, so you will find an appointment slot right away. Ralph H. I'm giving just initial for the last name. Does one essentially have to be a patent day trader to generate enough trades? If you trade securities, you need 30,000 to be a patent day trader for 4-to-1 leverage rather than 2-to-1 intraday, and to make a lot of trades to qualify for trader tax status. Without PDT, patent day trader status, it's hard to have enough trades. But that doesn't apply to the futures trader or the Forex trader. So there is a little bit relation. Carol L. When does the employer 401k need to be made? So you're going to do it on the December payroll and pay it by the end of January. My last year-end post for business had some of those details. And when you work with our team, Carol, they'll make that clear to you. Craig, it's the second, third, fourth question. DG, do trading advisory businesses still need to be business trader qualify MTM? Yes. If you're an investment manager, that's a business treatment for business expenses, but that doesn't give you the right to elect 475. You need trader tax status to elect 475. Trader tax status is undergraduate school. You may never go to grad school, which is 475. You may prefer to have capital gains treatment. They're related, but two separate things, and getting mixed up on that can have really big consequences. John Z. Can you set up a defined benefit plan if you're 65? I have to check my blog post. Go to the blog, click the blog button. There's the archive. Find defined benefit plan. It's probably in that post. Chris H. Can LLCs get trader tax status? Yes. Does the LLC then get the same benefits as the S-Corp? Remember, there is no such thing as an S-Corp. There are LLCs and corporations, and even general partnerships in all but 6 states can elect S-Corp status. We prefer the route to the S-Corp being the LLC. So LLCs can be taxed as partnerships if there's more than one partner. A single member LLC can elect S-Corp status, a multi-member LLC can elect S-Corp status, or a multi-member LLC can be a partnership return. We don't want a single member LLC to be disregarded for the whole year, because then they're back to the Schedule C and they can't do the employee benefit plan deductions. We only want the single member LLC for this month to expedite the account openings. Michael W. How do unreimbursed partnership expenses affect partner outside basis? That's a little bit above the scope of this conversation, Michael. You might be a CPA. Check back with us. You can talk to one of my partners about that. Mark L. When do the tax cuts take effect? 2018, except for the 100% expensing. That starts September 27th. In the House bill, they wanted to change the mortgage deduction on that date too. And then the C-Corp rate is in the Senate bill 2019. So basically next year. David S. Do options trade qualify under 475? Yes, you can elect 475 on securities only, or on commodities, which are 1256 contracts only, or both. We recommend it on securities so you get the tax loss insurance and exemption from wash sales. But we don't recommend it on 1256 contracts because you would give up the lower 60/40 tax rates, which are about 1/3 off the regular rates. Equity options are securities. Futures options are 1256. So you got to see what type of options. I have a lot of content on our website. Remember, you come over, let's take a look here. You come over to the Trader Tax Center. Go to Trader Tax Center, come down to tax treatment on financial products. And you look on there, you got options, you got Forex, cryptocurrency, ETF, securities, wash sales, the works right here. Spend some good time there, the trader tax status, all of that. Let me bring back the questions. We're going to go for a few minutes more, folks. So just stay with me here. Alexandro R. I currently hold a Forex only trading partnership. When would you recommend setting up the S-Corp? Now, because we want to get the S-Corp going for next year to get the employee benefit plan deductions. But if you call me up and you say, Bob, I don't have health insurance. The Senate's getting rid of the mandate. I don't have to not going to pay a penalty anymore. I'm not going to do it. And I don't need a retirement plan. I'm young. I don't like the retirement plan trading options. But I prefer the partnership return for various reasons. It looks better than the Schedule C. So you may not need the S-Corp. Let me assess your situation in the consultation. Jack L. When is the best time? Now. Get on my schedule now. Do the consult with me now. We have a lot of good visibility. We can kind of do the consult today, but then form the entity next week. We'll maybe hear back from the House and Senate more by next week. They're acting fast. We're not going to do something before we are sure about what we're doing. And again, if we form the single member LLC, we have until next March 15th to file the S-Corp election. Craig, a lot of people have multiple questions. You're going to need the consult. Jerry P. Does the possible Tax Cut and Jobs Act of 2017, well, it's really 2018, eliminate 1256? No. The tax bills don't touch trader tax status. Don't touch 475. Don't touch 1256, 988, wash sales. All the stuff, all our bread and butter, untouched. We're very happy about that. The wish list that we had, that you guys signed the petition on, that went to all the congressmen, I think it helped work. Maybe not. Maybe it made no difference, but it did pretty much work. I think we got into the qualified business income. We're stuck in the service business category for now. We'll try to get us out of that. But I think we're doing pretty good on the tax cuts. Max Z. Why can't we just start everything in 018? Yes, you can. Form the entity the first week of 018, the second week. Start it sometime in January. You'll have a little individual tax compliance for January. If you're a futures trader, big deal. Even if you're trading securities, so you run the trade log just for 1 month. Not a problem. Don't rush in December. Enjoy the holidays. Wait for the final ink to dry. Wait for the dust to settle. We'll work this out in January. That's fine too, Max. B.S. Can a Section 475 trader that does not need employee benefits still benefit from the pass-through? Absolutely. You can not get the cake and just eat the icing. It's not good for kids, but it's fine for you. You can get the pass-through tax, and you can then do that with a partnership. You don't need the S-Corp. If you just want the pass-through tax cuts and you don't want the employee benefit plan deductions, let's go with the partnership return, general partnership or multi-member. You need a partner. So you don't want to just include a friend, or that could be investment management. So if you're spousal, then you go for the partnership. Maybe with a parent, but talk to me about it. Anthony W. With an S-Corp that meets TTS, is the net income after all deductions for salary? Yes, it's net. It's a qualified business income. So if you're trading securities without 475, it's 89.49. It goes over to Schedule D. But what's nice about an entity return is we see it all. So again, QBI excludes investment-related capital gains. I have to make the case, and hopefully we may have to wait for some of the regulations to come out, that business-related capital gains should be in QBI. If you want to play it safe, you want that 475 election, especially if you're a securities trader. You probably should have had it all these years anyway. It doesn't apply to your investment positions. So you want to get back with me to have another touch the base consultation. VS, Vincent S. I formed an S-Corp back in August. Initially, we'll have a loss. I would like to still establish, no 401k if you have the loss. We don't like it. We think it's abusive. The IRS won't like it. Remember, we're creating earned income. And the IRS favors that. They would disfavor doing it with a business loss. So we would not do that. That's why we wanted you to wait. You can do the health insurance. Maybe you can do a little bit of the elective deferral if you talk to us, but absolutely not the profit sharing. But in general, don't do the solo 401k. DG. We file a partnership. Can we choose to file the S-Corp? Yeah. So if you have a partnership this year and you want the S-Corp for next year, you do it by March 15th. You file the Form 2553. Most states accept it. There's going to be a lot of planning with entity conversion. C-Corp to S-Corp, S-Corp to C-Corp, partnership to this. The bills provide some better transition rules that Senators Johnson and Daines insisted on. That's getting in the weeds. It's above today's scope of today's content. We're going to be on top of all that for you, so you're going to consult with us about it. Diego K. What are the news or alternatives on House Senate AMT? The Senate brought back the AMT, alternative minimum tax, to close the gap on the deficit, which they absolutely couldn't get off the 20% corporate rate. Trump gave them a little breathing room on that after they signed passed the bill. The House, Brady, is saying absolutely no AMT. I mean, they're willing to go for a lot of the Senate provisions, but they're saying absolutely no AMT. They want more reform than the Senate. So AMT may get backed out again. That may be something the House wins out on. So it certainly complicates things, and it would be a much higher exemption. Icy, for those creating S-Corps in 2018, can the potential trading accounts be used under this new S-Corp? No, you never have a personal trading account under an entity. You have to go to your broker, IB, and open up an entity trading account. And that will probably unleash the higher professional data fees. But IB's commissions are so low that that's something that entity traders think is still very worthwhile to do. And you may get your data elsewhere as well. But the point is that you need an entity account. You cannot have a personal account. That would be illegal. The IRS would not go for that. A lot of tax court cases got bounced on that. People set up an entity but never opened up the entity account. Mike T. Why can't I pay myself a guaranteed payment of spousal partnership due? Okay, 50-50 owned. You pay out the fee. You got a little SEI. Then you pick up the partnership loss on Schedule E. It drains out the SEI. You get hardly anywhere. You achieve pretty much nothing. You might get away with a tiny bit of earned income, not efficient. Read my guide about that. I go through the whole thing in Green's 2017 Trader Tax Guide, which is on discount now until the 018 guide comes out in January. Then it's full price again. Niles C. Now, Cynthia, if you got to jump in and cut me off and say we're ending, tell me when. Otherwise, I'll answer a few more questions.
Well, keep going, Robert. You were so informative. As long as you can stay, we'll keep this open.
Okay, good. I'll try to get to one question each. Some people have multiples. I'm not going to do that. Niles C. As a profitable options trader not qualifying for TTS, do you still recommend the entity? No, because you're not a business. You're an investment company. So the ticket to everything is trader tax status. I coined that term. I call the balls and strikes on it. I'm an umpire. You come to me for a consultation. Sure, I'm your advocate for all traders, and I'm on your side. But when I ask you to pitch me the ball and tell me your facts, I'm going to call the balls and strikes the way I see them. And if you strike out on trader tax status, you strike out. We won't sign a tax return giving trader tax status when we don't think the person has it, and we're not prepared to fight to the end with the IRS to win it. And that's why we have credibility with the IRS for all clients, because of our integrity as a firm on that issue and other issues, 475 included. Rank V. Is it true that MTM traders can't carry back 2 years anymore? That's right. Any business loss, I remember I said at NOL, they repealed the 2-year carryback. My partner, Darren Neuschwander, when he works for the AICPA task force, when they went to the IRS to try to comment about all the bills, his pet peeve was the NOL carryback. He fought hard to get that. That's one thing we lost. I don't know why businesses need NOL carrybacks to replenish capital, to retain jobs. That, I think, was a very business-unfriendly decision of Congress. And it was against the spirit of American taxation, which has always had that and makes us unique in the world. Other countries didn't have it. We had it. It helps businesses stay alive. Carson W. What do you recommend for traders who don't qualify for TTS? Well, you have investment expenses in 2017. They're only deductible in excess of 2% of adjusted gross income. They're not allowed for AMT. They don't include home office, education, and Section 195 expenses. You get puny deductions this year. Under the Senate bill, you get zero next year. They repeal investment expenses. The House made a big deal. Oh, we're getting rid of all itemized deductions. The House left investment expenses. Very few people talk about this. I'd like to see how it gets reconciled. They left the carried interest in. They extended it to 3 years from 1 for getting the long-term rate. But if, in fact, investment expenses are repealed, that could have a major impact on the investment management industry, because carried interest saves that issue a little bit, because instead of paying 2 and 20, the 20 is a reduction of capital gains. Could you imagine if people pay much higher advisory fees and can't deduct them? That's a problem. So if you're a trader, you don't have TTS, you're going to get very few expenses next year. So you want to keep your expenses low. Think about trading your retirement accounts more. Think about a Roth IRA conversion. You won't be able to do a reversal anymore. This is your last year to do a reversal. You can do the Roth conversion today, this month. Next year, the conversion assets drop. The market goes down. Your assets go down, and you can reverse it by October 15th next year. But next year, if you do a conversion, you can't reverse it anymore. The IRS doesn't want the reversal anymore. Traders are good at trading retirement accounts. They can beef that up with an incredible benefit, and the retirement plan can reimburse you for investment expenses only that are allowed under Section 212. But again, they may close that out for next year. So think about trading retirement accounts more, and think about getting 60/40 benefits with trading futures. Those are some things you can do without TTS. I had a long answer on that one, but it was a good question, and I don't want people to think that we only help TTS traders. We help the non-TTS traders too. So if you strike out, we don't push you out of the ballpark. We still help you. Jack L. How to admit a spouse to a partnership. You just have a modification to your partnership agreement on January 1st, effective January 1st. Robin P. Is withholding income required to make solo 401k? If you do your payroll on 144 to do the full solo 401k in December, beef up the income tax withholding, federal and state, to pay what you owe the IRS and to pay what you owe the state in full. And then you don't have to make a Q4 estimated tax payment, and that will avoid the underpayment penalty on estimated taxes. That's another benefit of the year-end payroll. Tesh D. Once you elect 475, it stays forever. You can revoke it. The IRS eased it. See that on my blog in the guide. The same way you elect it is the same way you can revoke it, with the election by the due date of the prior year, the 3115, without any fee. The IRS made it easy. Rao C. If you have an account for trading, however, it did not qualify in trader tax status in 2017, what would be the setup to make the account eligible for 18? Every year you put the bread in the oven. You pull the bread out of the oven at the end of the year. If it rose, it's bread. If it never rose to trader tax status, it's flat bread. You can only use, so it's a facts and circumstances assessment. The 475 election is hanging out there. If you don't qualify, it's suspended until the next year when you may qualify. All this is in the guide, folks. Anthony W. Does the IRS look at the average number of trades for the year by month, weekday? Yes, all of those. 4 trades a day, 4 days a week, 16 trades, 15 to 16 trades a week, 60 a month, 720 a year per the Pope Court. That's what we're using as the bright line, although it's not a bright line test like the 31-day rule is on the Endicott Court. So you don't want sporadic lapses. So you don't want, a lot of trades in January, February, no trades in March. So you don't want sporadic lapses. All of this is in the guide. There are blog posts on it. Come to the website. Joseph G. I'm currently a 475 Schedule C trader. If we form the S-Corp, do we have to re-elect 475? Yes. The entity elects 475 internally in its own books and records within 75 days of inception, and you don't need the second step of the 3115 filing. So it's a lot easier for the new taxpayer entity. An existing entity has to do the external 475 election and the 3115. It's the new taxpayer that gets that loophole internal election. Ben Z. What if I'm a high-income trader above 500 in California? You're probably not going to get, the threshold phases out at 600 married, 300 single on taxable income. And so if you're way above that, so what you want to do in California, which we do for a lot of clients, is you have the dual entity solution. You have the trading partnership with your spouse or with your S-Corp, and you have your S-Corp that has a carried interest and a capital interest in the partnership. You limit the income in the S-Corp in California. And I have all this on the blog. Go to the Trader Tax Battle of the States, California versus Texas. It's on the website. It's in the guides. The S-Corp makes the target income. It maxes out on all the employee benefits. It doesn't pay any franchise tax above the $800 minimum. And the rest of the income is in the partnership with no taxation. So you're getting the best of the both worlds on the employee benefit plan deductions, but you priced yourself out of the past 2 tax cuts. And you can't use a C-Corp because of 8.84% corporate tax in California. Ignati P. If I have my health insurance for Medicaid or an employer-provided one, you can only do the retirement plan deduction on individual or group policy in your own entity. Employer-provided is not deductible. You could look to, I think, the contributions that you make to Medicare, like Part B, I think you can include those, and I have that on our content. Our CPAs would tell you for sure. Author K. Will it still be true in the new plan, carry forward continues? Yeah, the NOL carry forward is unlimited. It used to be 20 years only, it's unlimited, but they put in that 90% rule. I'm just going to answer a couple more. We're going to end in a few minutes. Matthew A. With respect to exchange membership and SEI, someone emailed me on that. That's above the scope of today. Traders don't have self-employment income except if they are a 1256 contract trader as a full member of a futures or options exchange under Section 1402I. 1402 is the self-employment income statute code. I is the exception. The full member has self-employment income. These are your professional futures traders in Chicago. This goes way back when they made the 60-40 deal with Dan Rostenkowski, ex-chairman of Ways and Means. Now, the CME has an electronic corporate membership, which is a reduced membership, and our tax attorneys felt that that probably did not trigger 1402I. Now, this person's asked me about ICE and the changing of the membership, and come to me with the exact membership deal, what it is. I can feed it into our tax attorneys to see if they feel there's grounds that 1402I would not apply. So if you have 1402I, you don't need the S-Corp, you already have your SEI. Canal M. I have losses in my personal trading account of 16-17 and planning to go full-time trader next year. In Texas, how do I create an entity? Well, you're starting fresh. So you want to have you do the 30-minute consultation with me. I answer all your questions. I assess your trader tax status. I find out your status with health insurance, retirement plan, your goals. I make recommendations to you. We discuss it together. We come up with a final plan. Then you sign up for the entity and we form the entity. And then I walk you through all the startup business issues of the entity, pass the baton to my partner, who then meets with you to make sure you executed everything right and that it's up and running right. So when we do the year-end compliance, it goes smoothly. I think you'll like the way our service works on that. So there's a lot more questions here on the board, folks. Cynthia, should I give it another 5 or wrap up now?
I'm going to leave that up to you because I think we could go all afternoon with these questions.
All right, I'll answer a few more because people are here and they have the questions. They came to get answers, and why not take this opportunity to give them an answer?
Well, thank you.
So Ty N. Started LLC during year, began trading regularly almost every day, but ran out of money. That could be a sporadic lapse that the IRS does not respect. Haven't traded months since. You might not have trader tax status, or you might have it for a short period. That's something you want to consult with me on. Chen traded for 3 months, lost his case because he lied about 475. He argued pro se in tax court, which means on his own. He caved on trader tax status for 3 months when the court said it should have been like a whole year. The court was wrong. It doesn't have to be a whole year. So many businesses in America start and fail in 3 months' time. If I argued Chen, I could have won trader tax status, but of course conceded 475 because Chen lied about 475. He never made the election. A lot of multiple questions. You folks want to email me, and I recognize some of your names, your clients anyway, so get back with me. This is not really the forum for that. Peter K. Can I request an appointment specifically? Well, what you do is you purchase a consult online. Go to the site. Go to, let me bring that up real quickly here. You go to professional services, go to consulting. Click on consulting, pick the 30-minute, read about how it works, purchase it. When you check out, you get a download, which is a link to my calendar. I have an online calendar. You see all the open appointments. You pick one, you're booked. You send me your notes. You call me exactly at that time. It works like clockwork. I make notes during the call. I can type as fast as I can speak, and I can speak pretty fast as a New Yorker. I try to slow it down. And then I send you the plan at the end, so you have a chance to read it over and discuss it with your spouse, and then get back to me for the next step, which might be the entity formation service. And then you would go down here and purchase that. So it's all on the website, all the strategies, the blog posts are here. You just hit find the categories like entities or different things. You can click a category of blog post. You can go back and see all the event recordings on our site or on the IB site. So let's go back to the questions. John A. Can a holding company, we don't really want a holding company with the trader tax status and all that. It just confuses the IRS. So the question's beyond the scope. MS, can you provide an example? Yeah, it's on the website. Go to that recent post right here. On the Forbes version didn't have the example. So you go to the home page, you click on this recent post. You scroll down to the bottom of the post, and you'll see the examples. They're right here. The S-Corp trader. Here's the S-Corp example, middle income trader. I did the S-Corp versus the C-Corp, and then I did the highly profitable C-Corp trader. And these are exact tax calculations showing you all the differences right there. Let's go back to the questions. TO, are there new FIFO rules? Absolutely. Everybody's upset about that. That's the one thing that they did change with trading. Most of our clients use FIFO. They're day traders, they're swing traders. There's no difference. They're in and out, they're all in cash at year end. The trade log software uses FIFO. But if you're an investor and you bought your Apple stock at different points over the years, you have different basis. When you go to sell it before year end, you want to sell out the losing positions for tax losses, or you want to sell out winning positions if you want to go to cash, but you want to sell the ones with the highest cost basis, specific identification. Next year, the IRS doesn't want any more games with that, so they're insisting on FIFO, first in, first out. They're letting mutual funds off the hook with average cost, but it's a little tricky. Let's see what happens in the end on that. There's been a lot of blowback from the brokerage industry about that. But on the other hand, taxpayers have gamed the system with the identification. They haven't really followed the rules at times about informing their brokers properly on that. So the IRS has tried to close the gap with the cost basis regulations, and this, I guess, is the next step. Max Z, if filed 475 last April, how do I know if I qualified? So yes, Max, you filed the 2017 475 election by April 18th, 2017 for 2017. You had to do it by that due date. Now it's the end of the year. You're going to prepare your 2017 tax return. Did you qualify for trader tax status to use it? If not, the election was null and void, and you don't have to file the 3115, and you can refile the election for next year. If yes, you do qualify, then you are compelled to perfect the election with step 2, the 3115 filing with your 2017 tax return in 2018. That's all in our guide. We can help do all that as part of our tax compliance service. That is our main service, folks, under professional services. Tax compliance is a fancy way of saying preparation and planning. Now is when you want to do the year-end planning. You're going to be a first-year client. You're going to have a 15-minute consult with my partner, Darren Nishwanda. He's going to make sure you're a good fit together, that we can save you some good money, you know what the price is going to be, and that we're going to move forward with the tax compliance service to do the planning before year-end. That's where you eventually want to wind up with us. That's our core business. Our raison d'etre for existing as a firm for traders. They need help with the compliance with all these nuances. Let's go back to John F. When you speak about 30-day holding, it's average. It's not sure if it's weighted average. There's no case law on this. There's no technical way to do it. There's no software app for it. There's no program for it. So you don't even want to be close to the 31 days. So you want to talk to me about it, especially as an options trader, if you're holding securities positions as well for hedging or for other reasons. Jing R. If I qualify for TTS in 2017, don't have any business entity, you can be sole prop. We can take all your business expenses and home office on Schedule C. That first benefit of trader tax status we can claim after the fact. We can think about a 475 election next year as a sole proprietor trader, the second benefit. And if we want to go for the third benefit, the employee benefit plan deductions, we need the S-Corp. And that would put us in a better position for the new fourth benefit, the pass-through tax cuts. So let's see. I see a lot of the same names here. S, Sanjeev, L. Are you subject to FICA on forming the S-Corp entity? No. The FICA is a Social Security tax. We're only doing that on the wages in connection with the solo 401k plan, not on the health insurance, not just because you have an S-Corp, only in relation to the retirement plan. And the income tax savings from the retirement plan is much greater than the cost of the payroll tax. The $18,000 elected deferral is 100% deductible. If you're in a 30 or 40% federal state tax bracket, minus the 15% cost, you're putting 25% of the $18,000 in your pocket net. You're saving thousands of dollars net of the payroll tax. Okay, folks, I'm going to wrap it up. We got close to the end here. I'll ask a couple more. Someone's saying about prepaying for compliance. Yes, sign up with us in December if you're a trader, so you get a year-end deduction and then do the year-end planning. I'll do a rapid-fire answer, a couple more here. No, I think I pretty much got it. So to finish up, folks, before I pass you back, come over to the website, click on the Contact Us, fill out a web form with your questions, or send an email, either one, or give us a call, and you'll get access to my calendar right away. I'm going to work around the clock through year end. People got delayed with these cuts. We have a lot of work to get done, new entities. I will be here for you on that. Our CPAs are doing all the year end planning. We are here to take care of our clients and new clients too. So thank you all very much for coming. We're looking forward to working with you. And back to you, Cynthia.
Well, Robert, thank you so much. Wow, this has been a marathon session, and terrific information has been relayed. Now, I did see several questions. Some were saying it's a terrific session, but my head is spinning. Well, don't worry. We have been recording today's event, and we'll be sending that out to each of you in about an hour. So simply watch your email for your inbox for a follow-up message that will include today's recording as well as a link to the webinar notes. You'll also find within there a link to all of our archived sessions where you can find not only today's event, but all of the others that Robert has already done for us as well. So with that, we are going to conclude our session. I do really appreciate everyone's time and for sticking with us this long. And Robert, thank you for being so generous with your time. We are going to conclude our session so you can all exit today's event using the X that's above your control panel. Thanks all for your participation and have a great rest of your day. Thanks, everyone. Have a good one.